Welcome to AM Best Audio.
Wildfire risk has evolved from a localized peril into a systemic challenge for insurers operating in California, threatening market participation, capital stability, and long-term insurability, according to the research study Trial by Fire, Reimagining Wildfire Insurance in California. I'm Lori Chortis for AM Best TV, and joining us now to discuss that and other key insights from the study are two of the report's authors, Dr. Mary Kelly, professor and chair of insurance at Lazaridis School of Business and Economics at Wilfrid Laurier University, and Dr. Anne Kleffner, professor and chair of risk management and insurance in the Has-Kane School of Business at the University of Calgary. Anne and Mary, welcome. It's a pleasure to speak with both of you today. Thank you so much for joining us.
Thanks, Lori. Thank you for having us.
So, Anne, can you tell us about how your research on California wildfire fits into your work on government intervention in catastrophe insurance markets?
Sure. So we've been studying how and why governments intervene in these markets for catastrophe risk. And what we see is that private insurers, although they can offer insurance, and they do for catastrophe risk, there's certain characteristics that cause some problems. One of those is highly correlated losses, which lead to exposure in very high exposure. High tail risk, meaning that there could be issues where the losses overwhelm the industry. There's volatility of reinsurance supply, which affects capacity and prices. And there's also an increasing protection gap, meaning fewer and fewer insured losses are insured. And governments intervene largely for those reasons. And when we look across the globe, we see that these different programs look differently in different places. And it depends a lot on the individual company or country's policy objectives and also the characteristics of the different perils. And so the design of different programs depends a lot on what you're trying to achieve. And so what we did is we were looking at these different programs to see how design affect the resilience of the market, whether insurers remained in the market, and also how effective the program was in the long term in terms of sustainability. So that's basically it. And then looking at California, there was an obvious problem in terms of trying to address some of these challenges.
Mary, can you discuss the key market failures the proposed California Wildfire Authority is designed to address?
Certainly. I'd say, if I have to pick, the overarching key market failure is a real lack of resilience in the face of wildfire risk. There is no durable mechanism in California to absorb that catastrophic wildfire risk without destabilizing the primary market. And we see some manifestations of that. The first is a pricing and regulatory friction. There has been, I'll say, movement in that insurers can now use CAT models to help price. So that should help with participation in designated distress areas, but just that'll improve the availability, but it doesn't ensure that there is a stable availability. The affordability issue hasn't been solved, and it's not clear that will prevent any post-event contraction. Fundamentally, there's a structural mismatch between that tail risk that the insurers can't afford to absorb and the fact, unlike earthquake, which can be separated out of a standard property policy, fire coverage is embedded. So what's happening is that your primary insurers are increasingly trying to uncouple that extreme wildfire exposure, shifting it into the FAIR Plan. FAIR Plan isn't really meant to absorb catastrophic losses. So that's a resilience gap. And we see that in that there is a capacity contraction in high-risk WI areas, increased non-renewals, but insurers still are willing to write other risks. That's a capital volatility response. And finally, the last piece we see is that reactive public intervention. So after wildfire events, there's political regulatory interventions, there's expansion of the FAIR Plan, we have a sort of a reactive management of losses, not a structural management of losses. And those are the key market failures.
Mary, how would mandatory insurer participation in a statewide wildfire pool change the way risk is shared? And what would that mean for overall market stability and insurer confidence?
Well, as we've been talking, Laurie, that's a great question. There are two distinct issues. One is a tail risk, that the catastrophic losses are highly correlated, capital intensive, and the other is going to be the adverse selection piece. So because that fire risk is actually embedded in the standard homeowners contract, mandatory participation in this statewide catastrophic layer will allow insurers to transfer that tail risk from their own balance sheets to this shared mechanism. That's going to isolate the tail risk. It's still going to allow primary insurers to operate at lower levels of risk. So we're not replacing the private market, which is really important. So that's going to improve firm level tail volatility. It's going to help insurers with capital planning, solvency management, reinsurance purchasing. The other piece that we have is adverse selection. And so with adverse selection, we need to crowd insurers in all to take a piece of this high risk area. So we can see that set up as some sort of risk sharing pool where these policies are going to be underwritten as normal homeowners policies, not within the FAIR plan, but each insurer will be responsible up to their catastrophic layer of sharing in a portion of that loss. So that's going to help improve insurer confidence because we're going to create a rules-based catastrophic framework where the amount of risk each insurer will have to assume is known in advance. It's going to reduce dependence on volatile reinsurance cycles. It should actually signal some sort of long-term structural stability. It's going to provide clarity around maximum exposure, capital expectations, and all this should sort of crowd those insurers back into the market.
And what role does actuarially sound pricing have in sustaining insurer participation while improving loss outcomes?
Yeah, so Mary just alluded to the fact that one of the key parts is that the private insurers remain in the game completely. So they're still underwriting risk, they're pricing risk, they're servicing policies. That's what they continue to do. So that's very important. The California Wildfire Authority offers this role or this layer, of catastrophe reinsurance. And one of the key things in terms of actuarial sound pricing is that it helps keep insurers in the market. And so with the actuarial sound pricing, insurers are able to charge what they need to charge for expected losses, for their reinsurance costs, for their capital requirements, et cetera. And insurers have the latitude to do that. It's not the role of the CWA. And so then if we have risk-based pricing for households that can afford it, then the question becomes, we also need to support affordability for those who can't afford it. And this is where there are different pieces to how this is achieved. One of them is that the CWA, because it's a state or public entity, it has tax exempt status. It's not trying to earn a profit. Because it can purchase reinsurance in bulk, that should also be a lower cost. So it's able to offer reinsurance at a lower price than the regular private market. So that's how it all fits together.
Mary, what role do targeted affordability support play in sustaining insurer participation while improving loss outcomes?
So as Anne has just mentioned, the CWA should be able to offer reinsurance at a lower price than what a private reinsurer would offer. Our model says, it's not that everyone is going to see that, quote, cheaper reinsurance. For our low and medium risk insureds, the price that can be charged to them from the CWA would be the price that would be charged from a commercial reinsurer. So there's going to be a subsidy created there. Unlike if you think with other government insurers, everyone sees cheaper prices. What we are recommending, and it's based on a model out of Australia, is that those that can still afford sort of the market-based pricing should pay that price or could pay that price. And what we propose is those internally generated subsidies should address not just high-risk households, but high-risk households that cannot afford risk-based premiums. So having some sort of means-based assistance ensures support is directed to those households that generally need it. It's going to prevent broad premium suppression. It should maintain insurer confidence in the system. We still have actuarially priced at the system level, but of course there will need to be some clear governance and an oversight mechanism.
Mary, what lessons from global catastrophe programs like Flood Re, Australia's cyclone pool, or the California Earthquake Authority are most relevant when it comes to managing wildfire risk?
There are a lot of common design features across catastrophe insurance programs. The first one is some level of layering. Primary insurers should retain a meaningful loss layer and remain responsible for their core business, underwriting, pricing, and settling claims. The more recent public programs should sit and manage that catastrophic layer above that layer that the primary market is willing to absorb. The one thing that we have found is that no catastrophe insurance program is fully resilient to extreme or novel events. This reflects that deep model uncertainty, the increasing likelihood of events that fall outside of historical experience. Because of that, we have found that programs are more effective when there's government involvement in that tail where it's acknowledged upfront. There has to be some clearly defined backstop, guarantee, assumption of extreme losses, and that's actually going to reduce resilience on some sort of ad hoc, politically driven post-event decisions. The one other thing is that government support, as we see with TRIP, does not need to be fully pre-funded. There can be post-funding models that can provide credible support while preserving flexibility. And the last piece that's really important are clear rules about what these loss layers are, who's responsible for funding, the declaration of events or trigger mechanisms. Any ambiguity around when an event is named or what qualifies for support actually undermines the confidence of a system.
And as underlying risks and markets change, how can programs remain resilient?
There are a few things. One is that there are some ways to create some flexibility in the program to begin with, which helps it evolve over time, and the program needs to be able to evolve over time as underlying risks change or markets change. And so, for example, being able to make changes to pricing or mitigation, or how, as Mary said, events are defined, or maybe a new risk might come into the program. That's another thing we've seen happen. Sometimes there are different provisions for how much, for example, the government will pay depending on the size of the loss. So this gives the program a degree of flexibility, which helps it remain resilient. But the key thing is to make sure that insurers are supported in remaining in the market, so that we don't see private insurers exit. So that, as Mary said, the government's role needs to be very clear up front. So that catastrophic loss piece is taken out of the picture to some extent, so that they know that they can remain solvent and viable over the long term. So that ensures this resiliency piece over time. The other piece, very important, is mitigation. So we need to have effective mitigation that's taking place. We need effective land use planning, building codes, et cetera. And without that, none of these programs really can remain resilient.
Mary, looking ahead, could a model like the California Wildfire Authority be adapted to address other climate-driven catastrophe risks beyond California? And if so, how?
Well, yes, this model that we're proposing is very adaptable. It's actually built around design principles that are going to apply whenever that cat risk exceeds private market capacity. So again, the key elements is that layering and risk sharing, where the primary insurers keep the first layer and there's some centralization in that catastrophic layer. Mandatory participation where appropriate, to avoid adverse selection to stabilize capacity. Actuarially sound pricing for the system overall. And we can achieve that affordability by having some sort of means-based targeted affordability support. As Anne just said, that mitigation piece is going to be important for resilience. And the last two pieces we talked about earlier, That clear trigger and event definition matters, and a credible role for the government to take that ultimate tail risk, whether it's through a backstop, a guarantee, pre-funded, or both funded. What's really going to change across jurisdictions is just the implementation detail that Anne was just talking about, not this architecture that we're proposing. So I think our key takeaway is that although this is framed as a California solution, we think it's a way that any jurisdiction could preserve that private market function of insurers while explicitly managing any sort of catastrophic tail risk.
And Mary, you just mentioned the implementation detail. What changes across jurisdictions or perils is the implementation detail, not the architecture?
Yes, so the definition of the peril, how you aggregate, flood events, windstorms, those retained layer losses, how much do primary insurers retain, where does the funding come from, what's the size of that catastrophe layer, when and where does the government come in for the tail. That's going to depend on, the peril, the jurisdiction, and it's ultimately fairly flexible.
Mary and Anne, this has been such a fascinating and insightful discussion, and it's been a pleasure. Thank you both so much for taking the time to speak with us today. Greatly appreciate it.
Thank you, Lori.
Thank you very much for having us.
That was Dr. Mary Kelly, Professor and Chair of Insurance at Lazaridis School of Business and Economics at Wilfrid Laurier University, and Dr. Anne Kleffner, Professor and Chair of Risk Management and Insurance in the Has-Cain School of Business at the University of Calgary. For AM Best TV, I'm Lori Chortis.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.